You check your account on a Tuesday morning, and there's a charge you don't recognize. $35. Overdraft fee. You were short by $4. $4 became $39. Now hold that thought. Because somewhere inside that same bank, on that same morning, another customer just got a phone call. Not an email. Not an automated text. A call from a person who knows their name without looking it up, who is asking whether they'd like to borrow $2 million against a portfolio they will never have to sell. Same bank. Same logo on the door. Same building, sometimes the same floor. Two completely different institutions. Because your bank doesn't run on one set of rules. It runs on about 6. And which set you get isn't decided by how honest you are, or how hard you work, or how many years you've been a loyal customer. It's decided by a number. And almost nobody has ever been shown the full ladder. You only ever see the rung you're standing on, and you assume that's just how banking works. It isn't. It's how banking works for you, at your balance, right now. So today we're going to climb the whole thing, $0 to $10 million, 6 levels, and at every single one I'll show you exactly what changes, why it changes, and what it quietly says about the system you've been living inside your entire life. Let's start at the bottom. Level 1. $0 to $500. At this level, the bank charges you for existing. Start with the monthly maintenance fee, usually around $12, and it's waived if you keep about $1,500 in the account, which is exactly the amount of money you don't have. Sit with that for a second, because it's the entire video in one sentence. The fee is waived for the people who could most easily afford it, and charged to the people who can't. That's not an accident, and it's not incompetence. That's the design. Then there's the overdraft fee, around $35 per transaction. And in the United States, banks have pulled in more than $5 billion in a single year from overdraft and insufficient funds charges alone. $5 billion. Extracted almost entirely from accounts with nearly nothing in them. And it gets sharper. For years, a common practice was to process the day's transactions largest first, instead of in the order they actually happened. Why does that matter? Because if you have $100 and you make 4 small purchases and 1 big one, running the big one first empties the account, and then every small purchase after it triggers its own separate fee. 1 shortfall becomes 4 penalties. That practice got sued into retreat, and banks paid out settlements over it. But it tells you everything about what the bottom of this ladder was engineered to do. Then stack on the rest. The out-of-network ATM fee, the paper statement fee, the fee for closing your account too soon, the fee to wire your own money to yourself. And if you don't have an account at all, it's worse. You pay a percentage of every paycheck just to turn it into cash. You pay for a money order to cover a bill that a bank customer pays for free. Here's what nobody says out loud at this level. You are not the customer. You are the revenue line. Your instability has been measured, priced, and turned into a product. And the price is high. Level 2. $2,500 to $5,000. Something quiet happens here. The bleeding stops. You cross the minimum balance, so the monthly fee vanishes. You've got enough cushion that a surprise car repair doesn't push you into the red, so the $35 hits stop too. Nobody calls you. Nobody congratulates you. There's no letter. You just stop losing money for no reason. And I want to be very direct about this. This is the most underrated jump on the entire ladder. Going from $500 to $5,000 does not make you rich. It doesn't change your car, your job, or your address. But it takes you out of the machine. Think about what that buffer actually buys. It isn't savings. It's armor. Because when you have zero margin, every small emergency becomes an expensive emergency. The tire blows, and you can't cover it, so it goes on a card at 24%. The rent is 3 days late, so there's a late fee. The account dips, so there's an overdraft fee. One $400 problem becomes an $800 problem. And you spend the next 4 months paying for the gap between what you had and what you needed. That's the poverty tax. It isn't charged by one villain. It's charged by everyone, automatically, all at once, the moment you run out of margin. The buffer ends it. And it's the only rung on this ladder you can climb without a raise. Level 3. $25,000 to $100,000. Now the tone changes completely. Now they want you. The mail starts arriving, and it's different mail. A credit card with rewards that are actually worth something. A mortgage rate 1/4 of a point below the one advertised in the window. A preferred or premium checking tier with a nicer card and your name embossed on it. And here's the part almost nobody ever tests. At this level, when you call and ask for a fee to be reversed, it usually gets reversed. Same fee. Same bank. Same phone number. Different answer. Nothing changed about the rule. What changed is that you now sit inside a customer segment the bank has calculated is worth keeping. Somebody, somewhere, ran the math. How much is this person worth to us over the next 20 years? And how much are we willing to give up to avoid losing them? At level 1, that number was small, so the answer was no. At level 3, the number is bigger, so the answer is yes. That's it. That's the whole mechanism. Your leverage went up, so the rules went soft. And notice what that reveals. The fee was never a law of nature. It was always a negotiation you didn't know you were allowed to enter. Level 4, $250,000. This is the level where you stop talking to a machine. $250,000 is also, and this is not a coincidence, the FDIC insurance limit. It's the exact point where the government's guarantee on your deposits runs out. So this is precisely the level where the bank suddenly wants to have a long, friendly conversation about where the rest of it should go. You get assigned a relationship manager. A real human being, with a direct line, who knows your name and your situation before you finish saying hello. Now compare the two ends of that experience. At level 1, you waited 40 minutes on hold, got a script, and were told the $35 fee could not be reversed. At level 4, a trained professional calls you to check that everything is going well. Nothing about you changed. Not your character, not your work ethic, not your intelligence. Only the number changed. But I want to be honest about this rung, because it's the one people romanticize. That relationship manager is genuinely useful, and they are also a salesperson. Part of their job is to move you into the bank's own investment products, some of which carry fees that will quietly cost you far more over 20 years than every overdraft charge you ever paid at level 1. At the bottom, the bank takes from you loudly, in $35 pieces. In the middle, it takes from you quietly, in percentages. Loud extraction is obvious and small. Quiet extraction is invisible and enormous. Level 5, $1 million. Welcome to private banking. And this is where the entire system turns inside out. Below this line, you borrow money because you need it, and it costs you a fortune. Above this line, you borrow money because it's cheaper than selling, and it costs you almost nothing. Here's the mechanism, and it's worth understanding precisely, because it's how a very large amount of the world's wealth actually operates. Say you own $1 million in stock. You need $300,000 for a house, or a business, or a boat. It doesn't matter. The obvious move is to sell some shares, but if you sell, you trigger capital gains tax, and the money you hand over stops compounding for you forever. So you don't sell. You call the bank, and you borrow against the portfolio instead. The shares stay exactly where they are, still invested, still growing. The bank hands you cash at a low rate, because from their side it's an almost riskless loan. They're holding your assets as collateral, and they can sell them instantly if anything goes wrong. And here's the crucial part. Borrowed money is not income, so there is no tax on it. Your investments keep compounding. You spend the loan. You pay a small amount of interest, often less than those assets are earning. And when the assets eventually pass to your heirs, the cost basis resets, and the gain that was never taxed on the way up simply never gets taxed at all. Buy, borrow, die, the person at level 1 paid $39 because they were $4 short. The person at level 5 accessed $300,000 for almost nothing, and paid no tax on it either. Both of them are customers of the same bank, on the same day. And I want to be clear about something, because this is the point where people expect me to get angry. Nobody snuck this in. There is no secret document. Every piece of it is public, legal, and written down. It is simply invisible to you until you're standing at the level where it applies. Level 6. $10 million and up. At the top, the bank stops charging you and starts protecting you. The fee schedule becomes negotiable. Not because you're a better person, because there are entire teams whose only job is to keep your deposit inside their building. Rates get written custom. Structures get built around your specific situation, and doors open that are legally closed below. Certain private investments, funds, placements, private deals can only be offered to people above a defined wealth or income threshold. That's written into securities law. The stated reason is protection. Those investments are riskier and less regulated, so the rules keep ordinary people away from them. But look at the second-order effect. Some of the highest returning opportunities are, by law, reserved for people who already have money. Wealth doesn't just buy better terms. It buys access to a completely different menu. And at this altitude, the bank's function has reversed entirely. At level 1, it was a toll booth, taking a small amount every single time you passed through. At level 6, it's a fortress, staffed, funded, and paid to make sure nothing is taken from you at all. Same institution, opposite job. So now let's say the quiet part clearly. Every fee at the bottom is priced for risk. Every discount at the top is priced for certainty. The system isn't cruel. That's what makes it so hard to fight. It's just perfectly, coldly logical. It charges you for being unpredictable, and it pays you for being safe, and being poor is by definition unpredictable, which produces the most brutal sentence in all of personal finance. It is expensive to be poor, and it is profitable to be rich. Not as a metaphor. As a fee schedule. The novelist Terry Pratchett described this better than any economist ever has. His idea was simple. A man who can only afford cheap boots buys a new pair every winter, and across 10 years he spends far more than the wealthy man who bought one good pair that lasted a decade, and the poor man had wet feet the entire time. That isn't a story about boots. That's a description of how the whole cost structure of a life changes depending on how much you can put down at the start. And here's the version of it hiding in your account right now. The average savings account in America pays something like 0.4%. A high-yield account at an online bank, one click away. Same federal deposit insurance, same dollars, same country. Pays close to 4%. 10 times the return. Same money. Same safety. The only difference between the person earning 0.4% and the person earning 4% is that somebody, at some point, told the second one that the option existed. That's the real gap. It isn't intelligence, and it isn't discipline. It's information, and the confidence to act on it. So let's turn this into something you can actually use. First, build the buffer before you do anything else. $500 sitting in your account will do more for your finances this year than almost any investment you make, because it ends the fee cycle that's silently draining you. Then, push it toward whatever minimum balance kills the monthly maintenance charge. That's a guaranteed return. And there is almost nothing else in finance you can say that about. Second, call and ask. Ask for the overdraft fee to be reversed. Ask for the monthly fee to be waived. Ask what they can do on the rate. The worst outcome is a no, and you'll have learned exactly which rung the bank thinks you're standing on. People at level 3 do this constantly. People at level 1 almost never do, and that single difference in behavior is worth real money. Third, move your savings somewhere they're actually paid. 10 times the interest rate for 15 minutes of paperwork is the best hourly rate you will ever earn in your life. Fourth, look at credit unions and the smaller online banks. They're structured differently, often owned by their members instead of by shareholders, and the fee schedules at the bottom of the ladder tend to be dramatically gentler. And fifth, the one that matters most over a lifetime. Understand that every level up doesn't just give you more money, it gives you better prices on everything. Cheaper credit, better rates, fewer penalties. Wealth compounds twice, once through returns, and once through the discount it buys you on the rest of your life. None of this makes you rich. I'm not going to pretend it does. But it stops the system from charging you level 1 prices when you don't belong at level 1 anymore. Because that's the real lesson in all of this. The bank never announces which rung you're standing on. There's no letter, no ceremony, no notification. It simply reads a number, decides which version of itself to show you, and quietly charges you accordingly. Most people spend their entire lives believing the version they were shown is the only one that exists. Now you know there are 6. If this changed the way you look at your own account, subscribe. I take one financial system apart every week, piece by piece, until it finally makes sense. I'll see you in the next one.